Hi there, I'm Tyler Ballhorn, and this is the Stockscores Market Minutes for November 15th, 2013. This week we're going to talk about reward for risk. Most traders judge their success in the market by how much money or percentage gain that they make. Now, unfortunately, this is deceptive because it does not relate the gain made to the risk taken. It is more valuable to consider the reward earned for the risk taken. The difference between your entry price and your stop loss price is the risk of the trade. Now, if you don't have a stop loss price, then it could be that the risk of your trade is the difference between the entry price and zero. So where you put your stop is important because it narrows the amount of risk. The difference between the exit price and the entry price, assuming you sell at a higher price, is the reward. And so you must ask, what multiple of risk did you earn in reward? Now you can plot this metric on Stockscores charts. So here's an example of a stock that I traded recently. Entry position at $7.87, stop loss at $7.40. That represented 47 cents a share in risk. Now this stock did very well, but what's important is how well it did relative to risk. Each one of the green lines on this chart represents an element of risk. And the longer you hold that trade through this upward trend, the more reward you got for the risk you took. Now to plot these lines on any Stockscores chart, bring up the chart to begin with, go down to the charting tab below the chart, or if you're looking at the small view of charts, look beside. And at the bottom here, you'll see risk reward. And that's where we want to put our entry price, $7.87. Stop loss price in this case was $7.40. And then click on Create Chart, and it will plot those lines on the chart for you. Even when you change time frames, those lines will carry into the next chart time frame. So that's how I use reward for risk on Stockscores. It's a very helpful tool to understand really how well did I do on this trade. All right, let's get into this week's analysis. Here is the weekly chart of the S&P 500 going back 3 years. What I want everyone to notice is that the trend in the S&P 500 has gone from linear to parabolic. You see there that the trend line is starting to become a curve. Now, that's a great thing if you're a trader because that means the money to be made right now is excellent. But what it also presents is a riskier market because trends that go parabolic usually correct, and they can often correct fairly sharply. So we have to say that this market is bullish. There's no sign of weakness in the market right now, but it is also getting more and more risky as price runs away from the upward trend line. A much less risky market is the TSX, the Canadian market, which is just starting its upward trend. Now, upside in the near term is limited to the highs of early 2011. My expectation is that the TSX is headed there in the months ahead, and once there it will probably stall and go sideways for a while. But certainly the TSX, because it's in the early stages of an upward trend, is less risky, but it also doesn't have the same momentum and excitement as the US markets have. Treasury bonds bounced off of support this week. That means interest rates fell a little bit lower. But the general outlook here remains a negative bearish market because you have a long-term downward trend. We're basically in a sideways flat trading range at the bottom of a downward trend line, and so I'm more or less neutral on treasuries, which means more or less neutral on interest rates. Until we can break down below that green line, I don't see a significant run higher in interest rates. Now remember, when the bond prices go down, that means interest rates go up. So there's an inverse relationship when we look at this chart. The Chinese market had a good end to this week, and that broke its sort of recent downward slide that has lasted the last 2 months. And it looks now like the Chinese market is going to resume that upward trend that started early in the summer. My expectation is that we will continue to move higher, much like the Canadian market, move higher into that horizontal line of resistance that I've drawn at $42 on the FXI ETF. Emerging markets also bounced back this week, bouncing off of their upward trend line. Not a lot of upside potential in the near term, simply because there's strong resistance there. But again, this market, like the Chinese, is slowly building momentum as stability comes to the global economy. US dollar is in that downward slide. It's had a bit of a bounce back over the last 3 weeks, but it's now encountering resistance, and I think it's actually more likely to move lower in the near term than higher. And ultimately, we could see it test that lower boundary, the green horizontal line of support on the UUP chart. Gold could benefit from a falling US dollar if that in fact happens. Right now, gold remains in its bearish trend, but it is consolidating sideways and really trying to build a base. Until that red downward trend line in gold is broken, I do not want anyone to get too bullish on gold, but it is trying to at least stabilize. And here we have the chart of oil, which has been selling off as tensions in the Middle East have cooled, really putting it back into the trading range that the oil market was in before those tensions rose up in the early summer. My expectation is we're a little oversold here, so in the short term we could see a little bit of a short-term bounce, but there's really no significant support until the green line on the chart, and so I do still see some near-term downward trend action. And finally, the fear index, which remains in a downward trend. Fear is not a factor in the market. That's dangerous because that means investors are getting complacent. But nonetheless, until you see signs of fear welling up again, I would remain relatively optimistic about stocks. US stocks are getting more risky as the trend goes parabolic, but without any sign of weakness, stay cautiously bullish. Canadian markets are gaining momentum. Oil and gold may bounce back from recent selling, but still need to overcome their longer-term pessimism. Well, that's the Treasuries market minutes, the Stockscores market minutes for November 15th, 2013. Have a great week in the market and trade well.